Go interactive with X-Ray, where we bring trading experts to you live in the platform. Choose sessions, watch live market analysis, and catch up on your favorite market insights anytime. Ask questions and go one-to-one with leading experts on gold, oil, FX, crypto, indices, and equities. X-Ray, your very own analysis team, right at your fingertips. That's higher trading from MarketsX. Discover how some of the top executives are trading their own companies with our Insider Trades tool. See who's been buying or selling stock and what their trades say about insider sentiment. Use this unique big data tool to make more informed stock trades. That's higher trading from MarketsX.
What's happening, beautiful people? Good morning, America. Good afternoon, Europe, and welcome to the Markets Pulse. Happy St. Patrick's Day, everyone. We're exactly 30 minutes ahead of the U.S. markets open, and today is the Fed Day. Over a dozen announcements are expected to come out this afternoon from the U.S., and the crude oil inventories data simply adds more gas on the fire. Although Jerome Powell indicated that the monetary policy will remain loose for some time, the yields curve suggests something else. More on this topic in less than a couple of minutes, guys, with my very special guest from the heart of London, Neil Wilson, Chief Market Analyst at Markets.com. Coming up. Right, and as promised, guys, ladies, gentlemen, traders, please welcome Neil Wilson from the heart of London, Chief Market Analyst. Neil, good afternoon. How are you, Neil?
Yeah, very well, thanks. Yeah, how are you?
Good, always good, always good. Always looking for a fight. I'm looking to pick on someone.
Well, hopefully it's not me.
No, it's never you. However, did you get a haircut? Still not.
No, it's still growing.
It's looking better. Well, at least one of us can say it's still growing. Now, Neil, big day in the markets today. Crude oil inventories, FOMC meeting. Fed will release its interest rate and also the economic projections for the next 2 years. But before we go into that, I have to mention a topic to die for, literally. Last night, the French Prime Minister announced that France is entering the third COVID wave. Germany has a 20% spike in infections in the last 7 days. And also other European countries seem to be suffering from a spike in infections as well. On top of all this, most European countries halted the use of AstraZeneca vaccine, even though World Health Organization and AstraZeneca said there were no clear links between the vaccine and the side effects discovered in only a tiny number of patients. Is there more to this story, you think, Neil?
No. I mean, I think it's. I think the sort of new the views of the doctors and the scientists seem to suggest that there's absolutely nothing behind, no reason to be banning it. There's a very similar number of blood clots reported in patients that have received the Pfizer vaccine, and it's never been doubted at all. I think it just goes back to this sort of. From the very start, the European nations were quite hesitant about the AstraZeneca vaccine. They, initially through a lack of what they thought was a lack of data that supported its use in older patients, and then it's really the leaders Macron and Merkel have not really got behind it. They've cast doubt over it time and time again, and they've had a real problem getting enough vaccine. So I think there's an element of the fact that they're just trying to. They're trying to deflect some of the blame, I think, because at home they're facing an awful lot of pressure from their voters because of the failure over securing vaccines, and so the cynic in me suggests that they're trying to deflect some of that blame to the UK and AstraZeneca. Perfect, easy to blame. Ursula von der Leyen has came out saying that she's worried about the UK today. That's the UK is the problem, I think she said. So it's a really dangerous game, I think, because they are playing with people's lives, and they're going to be putting people off getting the vaccine when they shouldn't be doing that.
Exactly. And this is what I see has been happening in the last week or so. However, we have some good news. France and Italy announced yesterday that they will resume distribution of the AstraZeneca vaccine if the European Medicine Agency says again that the vaccine is safe for use. Funny enough, the European Medicine Agency has already approved the drug once and repeated at a press conference yesterday that the benefits of the vaccine outweigh the risks. So the question is, why is the European Union failing to complete this mission? US is vaccinating 2.44 million people a day.
Yeah, it's tying itself in knots, and I think it going back to this problem of the political pressure that they're under, the failure to secure enough vaccines, the failure to roll them out, and also this sort of very cautious approach that I think seems to be driven by the French in particular about vaccines, and that is playing into the fact that out of all countries surveyed, certainly in developed nations, the UK is by far and away the leading nation when it comes to people saying that they're prepared to get the vaccine. People that are comfortable, it's about 75%. The French are at the bottom end, it's about 30-something%. So there's obviously a real problem in France, not just with the vaccine rollout, not just with playing politics with AstraZeneca, but also the fact that they're struggling to persuade the population to actually take the vaccine. So they're tying themselves in knots over this. Like you say, it's approved. There's no reason to stop it. And I think you just have to look over the fact that Angela Merkel is stepping down. The CDU in Germany faces a tough contest in the elections later this year. Macron in France faces Marine Le Pen, who's going to run in a very close race in the next presidential election, the way things are going. So I think they're looking at these elections. I think this is really a political thing rather than anything scientific.
But there's a lot of people in European countries that are horrified. They're terrified of getting the vaccine. And even governments have something to say. In some European countries, I don't know how to put it nicely. You might have some less educated people in the parliament, and they send these bad vibes to the population. And as you said, they are playing with people's lives. Anyway, let's hope the situation will get somewhere rather sooner than later. Happy St. Patrick's Day, by the way. Are you celebrating?
No, I'm Scottish. But it always slightly amazes me that the whole world recognizes St. Patrick's Day. It's a bit of an odd one for me.
Don't be mean. I was wondering why you have a pint of beer in your hand this afternoon. But anyway, so happier the Fed Day. Why is the interest rate decision today more important than other times, Neil?
Well, I mean, I think, you've got the fact we're on a bit of a tipping point, really, with the way things have gone under the pandemic. And the Fed's been really accommodative, slashed interest rates. It's been buying bonds at around $120 billion a month. And it's been keeping this steady sort of line of attack, if you like. Now we're starting to see that growth is picking up. We've seen the various investment banks, the OECD, raising their growth forecast for the US. We're expecting a bounce back in the economy this year in the region of somewhere between 6 to 10%. So it's going to be a very strong rally. Vaccines are going much better in the US.
Yes, 2 points.
So they're really, they're really ready to reopen, and many states are all practically reopened anyway. I mean, if you look at Florida, people are out partying as normal. It's some of the other states really have lagged that approach. So, but the fact is, the US is going to be booming again, and what we're seeing is a rise in interest rates. We've seen bond yields spike quite significantly between the December meeting, which was the last time we got the dot plot. So that's the forecasts among the policymakers about where they think interest rates will be. So that tells us when the first rate hike might appear. Currently, that's not forecast until 2024, but because of the rally in bond yields, surging growth, etc., we're expecting them to maybe bring that forward. And I think with the rally in yields, you've seen that the pressure that's exerted certainly on an intraday basis, maybe not, in a longer term basis, but certainly intraday volatility on tech stocks. You've seen the Nasdaq come off. So if you see these bond yields spike higher, then you could see the Nasdaq come off a bit more, and that's obviously going to weigh on the broader market. But it's quite a sensitive point, I think, for the Fed at the moment, because it has to signal really that it's or it seems to be willing to signal that it's going to remain really, really loose for longer. But at the same time, the market's saying, well, that's not really sustainable. You're going to have to be raising rates next year.
Exactly. The volumes on the markets were very, very low today. And Jerome Powell and the Fed indicated, as you said, that they will keep the interest rates steady for now. However, the yields curve indicates a potential change, and the Fed says they might increase interest rates ahead of 2024. 2023 was mentioned previously.
Yeah, I think that's certainly the way they're leaning. I think you need, I think, 5 policymakers to move their dot from 2024 to 2023 to get to a median dot plot of 2023. So currently, it's somewhere early 2024, maybe we're expecting, but I think you're going to see it move to 2023. But the market's still pricing one in 2022. So there's a tough kind of line that the Fed needs to follow to signal that it's still pursuing its policy mandate, which, with the recent changes last year at Jackson Hole, means a much greater emphasis on employment. So they need to get employment back up to full employment levels. Powell has been really leaning on the fact that although unemployment is improving, he actually thinks it's closer to 10% on the unemployment rate. So he's clearly worried about unemployment. And also they have this average inflation targeting regime now where they're prepared to let the economy run hot over a number of years in order to allow that employment number to get back up. And I think all that means is that we've got to see bond yields rise, we've got to see inflation rise.
Right. Yes, that 2% inflation target that I keep hearing about for years now. Anyway, can you imagine what would happen if the Fed increases the rates now after injecting almost $2 trillion in the markets, Neil?
Well, yeah, I think that would cause a bit of panic. Yeah.
Now, let's have a quick look at the US dollar index, because we're talking about the US dollar index. There you go. I don't know if you know this platform. It's MarketX. Right. We're looking at it on a week. You heard about it once or twice. Okay. Yeah. We're looking at the US dollar index on a monthly chart. It's currently trading at 90.90 or 90.91. And I think you know where I'm going with this. Should we follow a pattern? Should we look for a pattern in technical analysis, or it's all at the mercy of the Fed?
Well, I think the technicals reflect a lot of the fundamentals, really. So, or where people think things will be going. I think you're still in this well, I call it a medium-term downtrend of the last year. I think that's still the dominant force, but we have seen signs that it's maybe bottomed, but we need confirmation of that. I think you're starting to break out of that channel. So I might revise my dollar weakness narrative before long, but like you say, a lot depends on the Fed. If US bond yields really start to climb, you get the differential, could mean that the dollar becomes more attractive again. So it's a problem really to guess based ahead of a Fed decision. It's one that obviously traders like to look at, but it's always difficult because it could break either way. You get a lot of fake head fakes. So it's a tough one to trade. It depends whether you're trading intraday or longer term. I mean, I think there is room for the dollar to move higher, but I still think it needs to bottom out again. I don't think the weak dollar story's bottomed out enough, because I think you've got a massive amount of issuance coming over the hill from the Treasury, because it has to pay for all the stimulus. You've got potentially another $3 trillion stimulus package for the green infrastructure bill that Biden might be looking at. So if you've got all that extra stimulus as well, you've maybe got the Fed starting to taper bond purchases, or signal that it's going to taper bond purchases later this year. So there'll be worries in the market about whether the market can absorb all that issuance. So I think that there's still a bit of weight on the dollar. I still think there's headwinds for the dollar.
Yeah, but the US is doing much better than Europe. Now, looking at this chart, it's a weekly chart. We're in the center of the chart where you see the arrow. Yeah, we're looking at 2018, 5th of March, 2018, when the US dollar index was trading short of 90. 89.36 was the price back then. We're very close right now. But looking at it from a long-term view, I don't know, at least the 50% mark here should be an interesting one to look at. Talking about that, do we have any prediction? Do you know any prediction from consensus for the US dollar index for the year, or at least for the first and second quarter?
Well, our forecasts are looking at, as I said before, it's sort of looking for it to weaken through the year. So I think for it to retrace to 88. But as I said, that forecast is coming clearly because of the way the dollar's moved, clearly coming under some pressure. And as I said, I might need to revise the forecast based on what we're seeing. But I still think, as I say, that although the dollar can mount these charges higher, I think there's still another leg lower that it needs to make before it finally bottoms out.
It makes perfect sense because it didn't manage to touch the bottom. Now, one last question, Neil. How come in times like this the stock markets are booming?
Well, you've got a resurgent economy, and you've got a central bank. Although rates have risen, they're still very low historically, and you've got a massive amount of stimulus that's been injected. Don't forget that the 1.9 trillion that we talk about at the moment is on top of all that extra stimulus that happened last year. So there's a huge amount of liquidity that's needed to find a home, and that's really a key driver. But also, I think earnings expectations are improving. I think people think the economy is going to bounce back this year and into next year. So I think there's still a lot of positivity around the markets. And we've seen a washout. We saw a big sell-off obviously last year, massive sell-off. That cleaned out a lot of hands. We've seen a sell-off this year. We've seen a drawdown in the NASDAQ of 10% this year. That's allowed a bit of, kind of reassessment and kind of, redistribution of the hands, if you like, a reshuffling of the deck. And that's helped, I think, for the sustainability in the medium term for the market. Having had that 10% drawdown, it puts the market in a slightly stronger position than it would have been had we not had that drawdown happen.
Right, because there are more and more voices out there, not just the voices in my head, that talk about the potential crash of the financial market because apparently it's moving too fast, too soon, too much. Is anything indicating that from your point of view?
I'm not seeing that particularly. I think the risk of I think you're getting a risk of maybe big daily, even weekly drawdowns. I think you can get 5 to 10% drawdowns at any moment because of yields, because of bond yields shoot higher. The market freaks out at higher yields and then it sells off. But I don't think we're seeing a massive crash. We had the massive crash last year. I think that was the big crash. So I think the market is still in a good place, and I still think it's probably got room to move higher. And even with rates at even the 10-year yield is at 2.5%, it's still not so high as to really threaten growth stocks on a long-term basis. I don't think. I think you need to see a real spiral of an inflationary spiral taking hold. I don't think we're quite there yet. I think you see inflation rising to 3%, maybe 3.5%, and being allowed to stay that high. But I don't think you're at a point where yields are going to, we're not back to the 70s and 80s or whatever when you had 10, 15% interest rates. We're not in that world.
I wish we were. Now on this chart, we see the big drop that happened in March, end of February, beginning of March, when COVID hit last year, and since then it's all higher, higher, and higher. So let's see what's going to happen. Right, Neil, thank you ever so much for the valuable information. We'll see you tomorrow.
Yes, I think we are. Yeah, tomorrow.
All right. Fingers crossed for a stronger dollar if you need it today. And once again, happy St. Patrick Day. I know, don't hate me. I'm teasing. Right. Neil Wilson, everyone, from the heart of London. Thank you so much, Neil. I'll see you again tomorrow. Right. We're going to come back in a minute or so with the charts of the day, the signals of the day, and the U.S. markets open, guys. We're exactly 9 minutes ahead of the U.S. markets open in the most important market opening of the week. Stay tuned. We're coming back live in a few seconds.
Keep your finger on the market pulse with the News Alerts tool. Stay up to date on the latest sentiment across all the major asset classes. Uncover bullish or bearish signals tied to specific assets that could be developing before major price moves, and track how news sentiment correlated with price in the past. Track the news volume on an asset, its fear index, and get a better feel for its underlying strength. All with News Alerts, your central hub for market information. That's higher trading from MarketsX.
Boom, and we're live. What's happening, beautiful people? Good morning, America. Good afternoon, Europe, and welcome everyone to our live stream. Happy St. Patrick's Day, everyone. What a memorable day we have. Volatility is the keyword today, with a dozen of announcements in the economic calendar. But first, how is everyone doing? Let me know how you're doing in the comments box below. And remember to like, share, subscribe. Absolutely like, share, subscribe, and support us in delivering more great content. Now, let's get down to business. See what's happening in the markets today, March 17th, 2021. The Federal Reserve will announce today its interest rate decision, and even if Jerome Powell gave hints on the Fed keeping the monetary policy loose for some time, investors will watch for the FOMC Economic Projections closely, as yields rising might force the Fed to increase rates sooner than 2024. Mixed opening is expected today on the US indices front as volatility disappears ahead of the Fed announcement, with the Dow Jones and the S&P 500 closing yesterday at record highs. Crude oil is also on the radar today, with the crude oil inventories expected to show a surprising 2.964 million barrels after a surprise drop in inventories of 1 million barrels last week. And Bitcoin, guys, everyone's favorite, tanks trading just short of the 55,000 mark. Ethereum follows. U.S. markets open. Coming up. Right, and here we are, beautiful people. Let's have a quick look at the economic calendar, see what happened on the market so far and what's going to happen from now on, guys, because brace for volatility is the keyword today. In the afternoon, starting in half an hour after the U.S. market open, we're going to have a lot of announcements, a series of announcements. But let's see what happened on the European trading session. So, 150 last night, guys, GMT plus 2, we had a couple of announcements. The trade balance coming from Japan and the exports, which came out negative 4.5%. And we had the EIA monthly report released very early this morning from the US, followed by core CPI and CPI month-to-month and year-over-year in the Eurozone. All three of them came out as expected. No changes were noted. Shortly after that, we had the building permits coming out, negative 10.8%. We had building permits for February coming out, 1,682,000 versus an expectation of 1,750,000. Housing starts, negative 10.3%. Housing starts, once again, 1.421 million versus an expectation of 1.560. Core CPI on the Canadian dollar came out below consensus expectations, only 1.2% versus a 1.4% expected. And the CPI, guys, month over month for February came out lower than the 0.7% analysts were expecting. 0.5% was the figure. Now, in exactly 1 hour from now, guys, we're going to have the crude oil inventories and the Cushing crude oil inventories with a forecast of positive 2.964 million barrels in stock. And 2000 hours, guys, 2000 hours GMT plus 2. We're going to have the interest rate projection, for the second year, the interest rate decision, the FOMC economic projections, the rate statement, and the press conference, guys. Amazing volatility is expected this evening from the US dollar against all its other peers. We also, just ahead of midnight, guys, 2300 hours GMT plus 2, we're going to have the interest rate decision from Brazil, which already announced they will increase the interest rate to 2.5% from the 2% they had till now. This is what is happening. Let's have a quick look at top 5 things to know in the markets today, guys. And then we're going to move on to the charts of the day and the signals of the day. Very important U.S. markets open today in 4 minutes from now. So I'll try and fast forward top 5 things to know in the markets so we catch the U.S. markets open. All right, number 1 on the board, guys, and this will give us some hints on what will be discussed tonight from FOMC. The Federal Reserve will announce its monetary policy decision at 1800 hours GMT, and Chairman Jerome Powell's press conference will follow half an hour later. No changes to the rate of asset purchases or key interest rates are likely, so market attention will focus to the Fed's guidance, specifically on whether the dot plot of Fed officials' rate expectations shift to reflect an earlier tightening of policy than assumed previously. The Fed's current guidance implies no rate hikes until 2024, but the raise in bond yields in recent weeks has implied market expectations of an earlier move. Let's see. Also of note, the Federal Reserve will decide on whether or not to extend the current exemption for banks from the supplementary leverage ratio as a binding capital requirement, which is due to expire at the end of March. If the extension is not extended, banks may find themselves less able to make payouts to shareholders and to absorb the huge volume of treasury bonds being issued this year. Oh my God, the poor rich people. It's breaking my heart, literally. Right. What will they do now, the poor rich people? Right. Number 2 on the board, guys. Let's not be haters today. It's only Wednesday. Let's save the hate for Friday. Here's one central bank that will hike the rates. As I mentioned a minute ago, Brazil, in contrast to the Federal Reserve, which believes that inflation is not a near-term risk. The Central Bank of Brazil meets today against the backdrop of rapidly rising prices and a sharp loss of confidence in the policies of Brazilian president. Right, the Bank of Brazil is expected to raise its key rate by 50 basis points to 2.5% in a bid to stop a slide in the real that has lost over 10% against the dollar in the last 3 months, as inflation has risen to a 4-year high of over 5%. Funny enough, and America is still struggling to meet that 2% that they've been talking about for the last couple of years at least. Number 3 on the board, U.S. stocks set to open mixed, and Uber, guys, gives up the fight in the UK. Let's see. That's very interesting, especially for stock traders. And I also have a couple of more stocks for you today, which are definitely worth looking at. So, by 6:30 a.m. Eastern Time, the Dow Jones Futures and the S&P were effectively flat, lacking the volume in the markets as investors pull back today, waiting for the Fed announcement. The Nasdaq 100 futures were down 0.2%, reversing yesterday's modest gains. Before the Fed announcement, there will be February data on housing starts and building permits, as well as weekly numbers on mortgage rates and refinancing, one of the first sectors of the economy likely to show in a rising rate scenario. Well, guess what? It didn't happen. Now, stocks likely to be in focus later today include Uber, which finally gave up its battle in the UK not to treat its drivers as workers, whatever that means, as well as Alphabet and Apple after Google cut the fee it charges app developers to 15% from 30% for the first 1 million they earn through the Google Play Store. The move is unlikely to satisfy app developers such as Fortnite publisher Epic Games, which have filed antitrust lawsuits in various jurisdictions against what they see as monopolistic fee structures. Well, welcome to the big boys table, guys. This is what happens at that level. Number 4 on the board, a very important warning from Samsung. Samsung CEO told the company's annual shareholder meeting that the company's foundry in Austin, Texas is still offline due to reconfiguration after the cold snap that forced it to stop operations last month. Hey, apparently there is a serious imbalance in the global market for semiconductors. Yeah, and Samsung added that the platform is unlikely to be solved the problem, sorry, not the platform, is unlikely to be solved in the near future. Right, and number 5 on the board, EIA plays down talk of super cycle. Crude oil prices edged lower overnight after the International Energy Agency played down talks of the new super cycle in its latest monthly report on the state of oil market. It pointed to still high levels of inventories on a historical comparison and the fact that prices are being supported by the withdrawal of some 8 million barrels a day of output by the OPEC Plus deal. Advanced economy stockpiles fell for the 6 straight months through January, but were still 63.2 million barrels above the 5-year average and 110 million barrels above the year earlier levels, the EIA said. U.S. government data on weekly stockpile changes will happen in less than 1 hour from now. Now, ladies, gentlemen, traders, we are officially into the U.S. markets open. Let's have a quick look at the charts and see what is happening. I'm going to move to a 1 hour chart and see what is happening at the opening today ahead of the Federal Reserve interest rate decision and economic projections for the next 2 years. 64.30 for crude oil WTI this afternoon. We're looking at RSI somewhere down in the close to the oversold levels. We see a death cross to be formed on a 1 hour chart, guys, between the 50 and the 200 moving average. Okay, and we saw crude oil tanking today during the European trading session. Okay, so one of the two things will happen in less than 1 hour from now. Either we're going to see a spike that will push the oil price back to 66 or somewhere there in that region, or we're going to see a drop that's going to push oil price lower somewhere around the 62, 61, maybe 60, even 60 might happen. Now, Euro USD, guys, the most liquid, the most traded currency pair in the world. It's currently trading today at 119.09, almost 119 flat with the RSI flat. Stochastic, we don't have stochastic on the chart. We have MACD. There's no cross on the MACD just yet. So there's more potential to the downside than to the upside. But let's see. The markets take us by surprise every day. 138.99 for the pound, guys, for the cable. With the RSI trading somewhere in between, the MACD again trading somewhere in between. The markets are waiting for a catalyst from the US side of things. As we have a lot of announcements coming out, we're still going to have a few announcements coming out later. USD/JPY 109.19 with the RSI pointing upwards close to the overbought levels. We see a very important resistance level around the 109.20, 109.26, somewhere there where the price is right now. Let's see what's going to happen. The Aussie dollar, on the other hand, tanked today just like the euro and the pound. 0.7716 for the Aussie dollar. There is potential to the downside as we see this death cross being formed there, and still there was no aggressive movement, no notable movement on the charts just yet. Right, USD CAD, we're looking at USD CAD with potential to the upside, 124.79, and we see a 200 moving average at 125.40. RSI pointing upwards. We see the MACD crossing and still pointing upwards. We might see a retest of that 200 MA to the upside in a bit of time from now. Let's have a quick look at the S&P 500, guys, which opened to the downside today. There we go. Big gap on the S&P 500 at the markets open today. 3,943 on the dot for the S&P 500, and it keeps dropping. Let's have a quick look at the Dow Jones, which opened to the upside. Indeed, it was a mixed opening today, guys. 32,845.18 for the Dow Jones Industrial Average this afternoon, which traded more or less flat in the last few trading sessions, as you see on the charts. Quick look at the US dollar index, guys, which got a bit of a boost after the US markets open. 91.92 for the US dollar index. It kept the same price. There we go. Yeah, for quite some time now. It's still waiting for a catalyst. Nothing will probably happen before the Fed announcement. We see the RSI trading at exactly 51%. Yeah, flat. We see the MACD flat. Nothing is indicating any sort of volume, any sort of buying or selling power on the markets today. Gold futures, on the other hand, $1,727.05 this afternoon. The price is somehow supported by the 200 moving average. We see a very tiny upwards movement, okay, that happened on the last few trading sessions, but nothing big happened yet. However, it's good to see gold futures trading above the 1,700 mark once again. It's been a while since they traded at these levels. Right, 67.81 this afternoon for Brent oil futures. Again, we see the RSI pointing upwards. There might be, we see the candlesticks literally not moving for the last 4 hours. Okay, the price is a bit subdued by that 200 moving average. Let's see. We might see an incredible spike in 45 minutes or so. Yeah, bringing the price closer to the 69.50 or why not the $70 mark. Meanwhile, everyone's favorite Bitcoin is tanking, guys. 55,040 cents for Bitcoin. It took us by surprise a couple of days ago when it pushed all the way up to $61,608 on the Bitfinex exchange. Since then, it tanked a bit. It's only normal. Things like this happen, especially after a rally like this that's not sustained by technicals. More on Bitcoin and cryptocurrencies tomorrow, guys. Tomorrow afternoon. Join me tomorrow afternoon, same time, same place, for an incendiary talk about cryptocurrencies with my surprise guest. I'm not going to disclose the guest. We're looking at Ethereum, guys, versus the US dollar again on Bitbox exchange, 1,768.29 this afternoon. It's basically mirroring Bitcoin's movement, but at a different price. Right. This is it. Let's have a quick look at some technical signals, guys. Let's see what analysts expect from commodities this afternoon. Not a lot of volume in the markets today, guys. We're looking at gold with a strong sell indication on all 4 time frames. We're looking at silver with strong buy with the daily remaining a strong sell. We're looking at copper with strong buy indications on all 4 time frames. Crude oil, WTI, and Brent oil undecided. Strong buy shortly after the U.S. markets open. But the hourly is a strong sell and the daily remains a strong buy. Mixed signals, I don't know what to say about it. Natural gas, shy buy indication a few minutes into the U.S. trading session, followed by 3 strong sell indications. U.S. wheat, again, just a shy buy, with the daily and the hourly remaining a strong sell. All right, let's have a quick look at stocks, guys, and see what stocks are good to trade today from investing.com's point of view. ExxonMobil, guys, strong sell indications on 3 out of 4 time frames shortly after the U.S. markets open. BHP Group, strong sell indication on 3 of the 4 time frames. Microsoft in red. Walmart, strong sell. Apple, strong sell. Procter & Gamble, guys, strong sell on a 5-minute chart with the hourly and daily remaining a strong buy. Mixed indications. There we go. Bank of America, 4 green for Bank of America, strong buy positions. IBM, 4 out of 4. Strong buy indications. And Nestle, guys, again, is surprising us with 4 strong buy indications. Now, there's no point looking at currency pairs, guys. A lot of pressure on currency pairs this afternoon. A lot of pressure on the euro, a lot of pressure on the US dollar. And the only one that gives us a clear indication almost is the Aussie dollar, guys, with 3 strong sell indications. However, remember what happens every day. 45 minutes, 1 hour, 2 hours maybe into the US markets open. That's the time the markets need to settle. So don't jump the gun, guys. Look at something else. Hold your breath if you have to. I don't know. Do something else, but try and trade responsibly today, guys, because there is some big volatility expected. Kiwi dollar seems to be weakening versus the US dollar. Strong sell indication on all 4 time frames. And the euro versus the Japanese yen is showing us a strong buy on all 4 time frames. This is it. The pound versus the Japanese yen seems to be strengthening a bit, but this is it, guys. A lot of mixed signals, and no wonder. A lot of things will happen today. Right, quick look at the economic calendar once again. Yes, so we're going to have in 57 minutes from now, crude oil inventories and Cushing crude oil inventories, followed by press conference. Okay, from Germany. We might see the euro reacting a bit in about an hour from now. And all eyes will be on the interest rate projections for the first and second year, okay, on the interest rate decision, and obviously on the FOMC press conference that will follow shortly after. This is it from my side today, guys. Remember to trade responsibly and may all your trades be in the money. I'll see you all tomorrow.